Silver just ripped into the mid-90s per ounce, and the biggest force behind it isn't Teotihuacan, the headline, everyone asked. It's repeating. It enters the part of the market that literally forces participants to act whether they believe the story or not. And if you stay with me, I'm going to give you the exact checklist for the next 1 to 2 weeks, the levels that matter, and the one signal that tells you whether this turns into a controlled retest or a continuation squeeze that can gap right through your comfort zone. The easy narrative is the dollar weakened, so metals popped. And sure, a softer dollar helps, but that's the wallpaper, not the load-bearing wall, because the moment silver starts behaving like a market that's just tight in the front and anxious in the back, you're not watching emotion, you're watching a supply clock, and that's where the real pressure starts. Right now, the tape is loud. Silver has spent recent sessions swinging in the high 80s to mid to 90s after a surge that didn't just break a level, it reset what the market thinks is normal. This isn't a tidy grind. This is the kind of move that leaves liquidity behind, creates air pockets, and makes both bulls and bears feel like they're constantly late. And when that happens, the people who get punished aren't the ones who are wrong, they're the ones who don't understand what the structure is forcing. Because if this one level breaks, the math changes. Here's the conflict you need to see clearly. A lot of institutions, a lot of commentary, and a lot of short-term trading desks are incentivized to frame this as just another macro mood swing, risk off, dollar down, metals up, end of story. That framing keeps people calm. It keeps the narrative simple. It keeps the idea alive that price can be talked back down with a change in tone. But silver isn't just a story asset, it's a deadline asset. It's a futures and options machine sitting on top of a physical supply chain with frictions, lead times, and delivery windows. And those frictions don't care what the talking heads think. But that's not the part that matters. The part that matters is what happens when paper price discovery collides with physical availability and the collision shows up first in the plumbing, the curve, the spreads, the leasing and borrowing signals, and the behavior of inventory that's actually deliverable, not exists somewhere in a vault, but deliverable against the contract when it counts. That distinction is where most people lose the plot because they see inventory and assume it means available. In commodities, that assumption is how you get blindsided. Let's make this clean and practical. In a normal market, future prices are often a little higher than spot because carrying metal costs money, storage, insurance, financing. That's contango, the gentle upward slope that says, no rush, plenty of supply, pay to carry it. Backwardation is the opposite. The front is priced higher than the back, and the market is basically screaming, I want it now. Backwardation doesn't happen just because people are excited. It happens when near-term demand for actual metal, or near-term pressure to secure it, is stronger than the willingness to lend it out. That's why the curve is the hidden detail. And once you start watching the curve, you stop being surprised by the tape, because the curve tells you where the pain is located. The next detail is what flips the whole setup. Silver's dollar story only works through mechanics. A weaker dollar changes 3 things that matter right now. It changes the purchasing power of non-US buyers, it changes the collateral math for leveraged players, and it changes real rates expectations. How expensive it feels to hold something that yields nothing. When the dollar index slides toward levels the market hasn't respected in a while, think around the high 90s area, global buyers who think in euros, UN, rupees, or pesos often see silver as on sale in their terms, even if the US price looks high. That's the first mechanical nudge. The second is funding. If markets start repricing rate cuts or even just repricing the path of rates, it changes the entire posture of carry trades and hedges. And the third is psychology. A wobbly dollar makes people reach for hard assets, not because they wearing tinfoil hats, but because institutional portfolios are built on rules. Rules like diversify currency exposure, hedge tail risk, reduce concentration, own inflation-sensitive assets. Those rules don't need a conspiracy to activate. They just need volatility. And volatility is exactly what we're getting. But here's the twist. In the last day or two, we've also seen a sell America style impulse show up in the way markets are reacting to geopolitical and trade tension, stocks getting hit, the volatility index perking up, safe havens catching bids, and currencies getting messy. That matters because it's the kind of catalyst that can thin liquidity at exactly the wrong time. Thin liquidity is when small flows create big prints, and big prints in silver are exactly how a gamma problem starts. But that's not the part that matters. Now let's talk about paper versus physical in a way that's actually usable. The COMEX futures price is the reference price for the world, but it's also a leveraged arena. You can control a lot of notional exposure with relatively small margin. That's powerful, and it's also fragile. When price moves fast, margin requirements can change, volatility can spike, and the weakest hands get forced out, sometimes right into the move. That forced behavior is why silver rallies feel violent. Meanwhile, physical silver has its own reality. Mining output isn't something you can ramp overnight. Refining capacity has bottlenecks, logistics are slow, and a meaningful chunk of silver supply is byproduct, coming alongside copper, lead, zinc. That means even if silver's price doubles, you don't automatically get double the silver supply next month. You get a longer-term incentive effect, but the near term is sticky. Sticky supply plus deadline-based demand equals stress. And stress shows up first in deliverability. Here, S, where most people get tricked, warehouses can report a large amount of silver sitting eligible, meaning it meets specs and could be delivered, but isn't currently registered for delivery. Registered is the stuff that's actually warranted and ready to be used to settle contracts. Eligible is could be, registered is, and in a squeeze-prone market, could be is not comfort. Because the owner of eligible metal has to choose to convert it to registered. And if the owner thinks prices are going higher, why would they volunteer their metal at today's terms? That choice is what turns inventory into a behavioral variable. And once inventory is behavioral, it's no longer a simple supply number, it's a negotiation. That's where the real pressure starts. Now, you don't need to pretend every inventory move is dramatic. Sometimes it's routine transfers, sometimes it's accounting. But in a market where price is exploding and the curve is getting jumpy, inventory behavior becomes a signal. If registered starts looking thin relative to open interest and delivery demand, the market tends to pay up for immediacy. That's how you get backwardation. And backwardation is basically the market paying a premium to pull metal forward in time. Think of it like surge pricing for availability. The key point, the premium can pull the entire price structure higher because arbitrageurs and hedgers respond. If front month is rich, it changes roll behavior, it changes how people hedge, it changes how people warehouse and finance metal. And that's not the part that matters. The part that matters is what it forces participants to do. Start with industrial users. If you manufacture something that needs silver, electronics, solder, specialty components, and yes, solar, you don't have the luxury of waiting for a perfect dip. You're not trading, you're procuring. Procurement works on schedules. It works on contracts. It works on, we need X amount by Y date. When price starts spiking, the first instinct is to delay, substitute, thrift, redesign. But redesign takes time, qualification takes time, and supply agreements don't rewrite themselves instantly. So in the near term, procurement can actually get more urgent, not less, because nobody wants to be the buyer who gets caught short in a tightening market. That urgency shows up in the front end. Meanwhile, investors show up with a different mandate. They're looking for protection, convexity, a bet on macro stress, or a bet on a broader commodity cycle. Those flows show up in ETFs and in options. And when ETFs start accumulating metal, that can translate into physical tightening because those trusts often source bullion to create new shares. Now, we need to be careful here. ETFs aren't a magical remove supply forever button, and flows can reverse. But as a proof point, ETF holdings trends matter because they tell you whether the bid is sticky. Sticky bids are what carry trends through volatility. And volatility is going to be the weapon used against you. We'll get to that. But first, options. Because if you want to understand why silver doesn't just rise, why it launches, you have to understand how options hedging can turn into gasoline. Here's the simple version. When a lot of call options are bought, the dealers who sell those calls often hedge by buying the underlying exposure. As price rises, the hedge requirement can rise too, especially if the market is in a positive gamma situation where delta changes rapidly with price. That hedging is mechanical buying. It is not bullish sentiment. It is forced risk management. And forced buying into a rising market can create reflexivity. Buying pushes price up, which increases hedge needs, which pushes price up. That's a feedback loop. It is why rallies can feel like they climbing a wall, but also like they were being pulled by a magnet. And that's where the real pressure starts. Now, layer in thin liquidity, like what you can get around month end, around options expiry windows, around delivery periods, or around sudden geopolitical shocks, and you get air pockets where offers vanish. That's when you see silver jump dollars in minutes and then whip back just as fast. Those whips are not random. They're the market testing where the forced flows are. The next detail is what flips the whole setup. Volatility itself can become a signal. If implied volatility for silver proxies is elevated, think options pricing in massive moves, that tells you two things. First, the market expects turbulence. Second, margin and risk limits will tighten. Tight limits force participants to reduce exposure, which can create liquidation. Liquidation is the bull AS enemy in the short term, but also the bull AS fuel in the medium term because it removes weak hands and concentrates positions into stronger hands. That's why you can get a brutal down day in the middle of a bull run and then a violent rip higher right after. It's not because the story changed, it's because positioning changed. But that's not the part that matters. What matters is your roadmap. Before we get there, we need a proof stack, multiple layers that point to the same pressure. Layer 1 is the chart structure. Silver didn't just drift higher, it broke key psychological levels and did it with urgency. When a market that spent years being dismissed suddenly clears a round number like $50, then $60, then $70, and then rips through $80 into the 90s, you're not looking at a normal incremental repricing. You're looking at a market that's repricing its own volatility regime. And volatility regime shifts are when long-dated participants wake up. Layer 2 is the dollar context. A dollar index sliding toward the high 90s while geopolitical and trade noise rises is a cocktail that tends to lift hard assets, not because people have a single unified thesis, but because hedges get layered across portfolios. Layer 3 is the term structure signal. Any persistent tendency for the front to stay bid relative to later months tells you immediacy is valued. Even if the curve isn't in constant backwardation, the behavior matters. Does the market snap back to contango quickly, or does it keep paying up for near term? Layer 4 is inventory and deliverability behavior. What happens to registered versus eligible, and what happens to withdrawals and reclassifications when price is high. If the market is truly flush, you should see comfort. Easy conversions to registered, stable deliverable stocks, less urgency. If instead you see tightness symptoms, that supports the thesis. Layer 5 is institutional flow. Do ETF holdings trend higher even on pullbacks? If so, that's a sticky bid. Layer 6 is the street symptom layer. Premiums, delays, and the subtle shift where physical holders become less eager to sell. You don't need exact premium numbers to understand the mechanism. Friction rising in the physical layer is usually an early warning that paper price can easily bully the market back down. Layer 7 is the industrial adaptation story. When price spikes, industrial users try to thrift and substitute, which can cap demand over time. That's a legitimate counterpoint. But the key is timing. Substitution is not instant. It can slow the bid later, even while the near-term market remains stressed. That timing mismatch is how you get a final shove higher before a consolidation. And that's not the part that matters. The part that matters is why now? Why this week? Why this month? Here's your calendar trigger. We are in a window where multiple forced behaviors cluster. Month-end and quarter-end periods matter because funds rebalance. If equities wobble and metals surge, portfolios can become out of balance relative to mandates, which creates mechanical selling of winners or buying of laggards depending on the strategy. At the same time, futures markets have roll windows where participants move exposure from one contract month to the next. Those rolls interact with spreads. If the spread is tight or inverted, rolling can be expensive, which changes behavior. And then there's options expiry. Even if you don't trade options, you are trading in a market shaped by them. Around expiry, the distribution of open interest across strikes can create gravity wells, where price is pinned, or trap doors, where price accelerates once a strike is cleared because dealer hedges flip. This is why certain levels feel like they're guarded until they're not. The next detail is what flips the whole setup. If silver is sitting near a cluster of heavy call strikes and it pushes through, you can get a burst of mechanical buying. If instead it fails and drops under a key support, you can get the opposite. Dealers selling to reduce hedges, momentum funds de-risking, and a cascade down to the next liquidity pocket. That's why levels matter more than narratives in the short term. So let us put some structure on levels that matter without pretending we have a magic number. In a market that just surged into the 90s, you're usually looking at 3 zones: the breakout zone, the first retest zone, and the oh-no zone. The breakout zone is the last major consolidation before the explosive leg, often in the 70s to low 80s area in this kind of move. If price ever comes back there and holds, it tells you the market is willing to defend the new regime. The first retest zone is closer, often around prior weekly highs or round numbers like $90. If silver can pull back, tap that zone, and hold without the curve relaxing and without ETF holdings bleeding, that's constructive. The oh-no zone is where the move starts to look like a blow-off rather than a transition. If silver loses a key round number and then can reclaim it, and spreads soften and the dollar snaps back, that's when the market can punish late longs. But that's not the part that matters. The part that matters is the 2 scenario lens, because this is how you protect your trust in your own process. Scenario 1 is the controlled pullback and retest. In this scenario, silver cools off because it has to. Volatility got too hot, positioning got too crowded, margin and risk constraints force a shakeout. Price pulls back toward a prior high or a round number, maybe the low 90s or high 80s, and it looks ugly on a daily chart. People panic, headlines turn, and then the key tells show up. The pullback is bought, the curve doesn't collapse into easy contango, ETF holdings don't dump aggressively, and price starts forming higher lows. If you see that, it's not weakness, it's digestion. Digestion is how trends survive. Scenario 2 is the continuation squeeze. In this scenario, silver doesn't give people the dip they want. It consolidates tight, liquidity thins, and then a catalyst, dollar slip, geopolitical shock, options positioning, a sudden inventory or delivery stress headline pushes it through a near-term high, and then hedging flows kick in. This scenario carries gap risk. It is the scenario where you wake up and price is several dollars higher before you can blink. It feels amazing if you're already positioned and disciplined. It feels like punishment if you're chasing. And that's where the real pressure starts. Now, let's address the counterpoint honestly, because credibility lives here. Silver's massive rally can eventually be capped by demand destruction and substitution. At very high prices, fabricators do the math and say, we can't absorb this. We have to redesign, especially in price-sensitive segments. We've already heard examples of solar manufacturers and electronic supply chains looking for thrift, thinner paste, improved recovery, or substitute materials where possible. That's real. But it's not instant, and it doesn't necessarily end the rally right away. Sometimes it changes the shape of the next phase. Instead of a straight line up, you get a volatile plateau and then a range as the physical market rebalances and the paper market recalibrates. Also, rising yields can complicate the bullish case. If the 10-year yield is pushing into the low fours and real yields firm, it can pressure non-yielding assets. But again, timing and context matter. If yields rise because inflation expectations rise, or because geopolitical risk causes a messy repricing, metals can still hold up. If yields rise because the market suddenly expects tighter policy and a stronger dollar, that's different. That's why your invalidation checklist matters. Here's what weakens this story fast. A sharp sustained dollar rebound, a clear sustained relaxation of front-end tightness, spreads calming, curve easing, evidence that deliverable availability is expanding and the market is no longer paying for immediacy. ETF outflows that persist through multiple sessions, and price failing to hold key reclaimed levels after a pullback. None of that means silver is done forever. It means the near-term surge thesis is weakening. And if you can say that out loud, you're already ahead of most people. Because most people don't want a framework, they want a feeling. And the market eats feelings. The next detail is what flips the whole setup. The market will try to emotionally manipulate you with volatility. Let's build your psychology shield. In a move like this, you will see days where silver drops hard, even if the underlying tightness is still there. You will see intraday wicks that look like the rally is over. You will see social media certainty spike at tops and disappear at bottoms. You will see headlines that make it sound like something changed fundamentally overnight. Most of that is noise layered on top of positioning and liquidity. Your job is to separate trend signal from noise. Trend signal is higher highs and higher lows on higher time frames, persistent tightness cues, sticky flows. Noise is one-day liquidation, headline whiplash, intraday stabs, and thin liquidity. If you can't tell the difference, you all do the market. Its favorite trick. Buy after a vertical day. Because you are afraid of missing out, then sell after a violent down day because you're afraid of losing it all. That's not investing, that's being farmed by volatility. And volatility is the weapon. So what do? You decide your time horizon before the candle prints. You size so you can survive the whip. You predefine what would change your mind. And you treat pullbacks as information, not as personal insults. But that's not the part that matters. The part that matters is what to watch next week, specifically. Here's the near-term roadmap, the way a pro would do it without pretending they can predict every tick. First, watch the dollar's behavior around key levels. If the dollar remains heavy and can't reclaim prior support zones, it keeps the macro tailwind alive. If it snaps back hard, metals can still rally, but it's a headwind you respect. Second, watch the curve and spreads. You don't need to be a spreadsheet wizard. Just pay attention to whether near-term contracts stay unusually firm relative to later ones, and whether the market keeps paying for immediacy. Third, watch volatility and options behavior. If implied volatility stays elevated and the market keeps grinding higher anyway, that often means hedging flows are still active and sellers are cautious. If volatility collapses while price stalls, that can mean the squeeze energy is dissipating. Fourth, watch ETF flow behavior. If holdings are rising on dips, that suggests accumulation. If holdings bleed for multiple sessions while price holds only because futures are propping it, that's a yellow flag. Fifth, watch the physical symptom layer. You're looking for the quiet tells, availability, willingness to sell, any sense that the physical market is less elastic than the paper market wants it to be. Sixth, watch the chart reactions at round numbers. In a high volatility regime, round numbers are where liquidity clusters. If silver breaks a round number like $95 or $100 and holds it, it changes psychology and can trigger new systematic flows. If it spikes above and instantly rejects, that can be a trap for chasers and a setup for a deeper retest. And that's not the part that matters. The part that matters is how you act in each scenario. In the controlled retest scenario, you're looking for stabilization, lower intraday volatility, better closes, and the absence of panic in the structure signals. In the continuation squeeze scenario, you're not buying because it's going up. You're respecting that the market is in a forced flow phase, which means you manage gap risk. That means you don't bet your whole account on one candle. It means you consider that price can whip around violently even if the thesis is correct. That sentence alone will save you money, because the most common way people blow up in silver isn't being wrong on direction, it's being right on direction with the wrong sizing, and getting stopped out at the worst moment by the exact volatility that later proves the thesis. So you plan for the whip. You treat leverage like nitroglycerin. You recognize that margin changes can happen and that brokers don't care about your conviction. You build a position that can breathe. That's how you stay in the game long enough to benefit from being right. Now, let's talk about one more hidden mechanism that people miss: arbitrage. If physical demand in one region starts to pay up, higher local premiums, tighter bars, different financing costs, arbitrageurs attempt to move metal. But metal doesn't teleport. It takes time, it takes logistics, it takes financing, and it takes willingness. In the meantime, the paper market can get ahead of itself and the physical market can resist. The closing of that gap is rarely gentle. It's often a snap. That snap is why you sometimes see silver surge even when the day S headlines done T seem big enough. Because the driver wasn't today's headline. It was a gap that became too profitable to ignore or a spread that became too stressed to hold. The next detail is what flips the whole setup. The more participants try to suppress their discomfort by shorting rallies or fading strength, the more fuel they provide if the move continues, because short covering is buying. And short covering in a thin market is violent buying. If you've ever wondered why silver can feel like it's quiet and then suddenly feels like it's sprinting, that's often the shift from voluntary buying to forced buying. Voluntary buying says, I like this price. Forced buying says, I need out. And forced buying doesn't negotiate. So where does that leave you right now, today, this week? It leaves you with a simple truth. Silver is not in a sleepy market phase anymore. It's in a regime where structure matters as much as story. The crowd will get emotionally yanked around while the underlying mechanics do what they do. If you understand the mechanics, you won't need to chase. You'll have a plan. You'll know what confirms. You'll know what invalidates. You'll know what kind of pullback is healthy and what kind is dangerous. And you'll stop letting the market rent space in your nervous system. Here's the subtle community moment, because it matters. The people who survive these moves aren't the loudest bulls or bears. They're the people who respect the market enough to think in mechanisms. They watch the curve, not just the candle. They watch flows, not just feelings. They treat volatility as part of the thesis, not as proof the thesis is wrong. If that's you, you're already playing a different game than the average headline-driven trader. And over the next 1 to 2 weeks, that difference is everything. So here's your final checklist in plain language burned into your brain. If silver holds key reclaimed levels on pullbacks, if the dollar stays heavy, if near-term tightness cues stay firm, and if flows remain sticky, the surge thesis stays alive, even if the tape scares you. If silver loses reclaimed levels and can't get them back, if the dollar snaps higher, if the curve relaxes and urgency fades, and if flows reverse, you shift from surge to range and you protect capital. That's not being pessimistic. That's being solvent. Because in silver, the move can be real and still be violent, and the only unforgivable mistake is pretending volatility won't test you. Keep your eyes on the structure, keep your ego out of the candles, and watch what the market is forced to do next, because that's where the truth leaks out long before the headlines catch up.